When somebody says in our community, the gold and silver prices are suppressed, if they weren't suppressed, we'd have a lot more purchasing power and everything would be better. I know I'm simplifying, I'm oversimplifying what they're saying, but like basically that's what they're saying. Why don't this manipulation end? And when it ends, we'll be back on sound money, everything will be better. That's true if you take it in broad strokes. I'm not arguing that. It's a double-edged sword because if the manipulation ends, what they call the manipulation, and what I'll agree is manipulation in a broad sense, okay, so I'm not entirely disagreeing. When that ends, we're going to be at the end game, and then everything's going to collapse if it continues. But we're getting habituated to it. So one day, gold's going to be up like $500. We're going to be like, oh, whatever, and then it's going to be up $1,000, and then we're going to be up whatever, and then it's going to be down 800. And this is going to be it's going to get crazier and crazier as we head to the end game, and then
Gold ended the week with a sharp rise of nearly 5%, driven by growing instability in global bond markets and renewed concerns over the sustainability of sovereign debt. The financial system was shaken by two particularly weak bond auctions. First in Japan, where a lackluster 30-year issuance led to the worst results in decades and pushed yields above 3.2%, and then in the US, where tepid demand for a 20-year auction sent 30-year Treasury yields soaring to 5%. These events triggered broader market anxiety, not because of surging growth expectations, but due to a rising sense that major governments may be approaching the limits of their borrowing capacity, casting doubt on the long-term reliability of sovereign debt. As confidence in traditional debt instruments falters, investors are increasingly turning to gold as a monetary anchor amid a backdrop of fiscal fragility and inflationary pressure. While gold offers no yield, its value lies in what it avoids: credit risk, counterparty exposure, and geopolitical entanglements. Recognized globally and historically as a store of value, gold is now being promoted by institutions such as the World Gold Council and the London Bullion Market Association to be formally classified as a high-quality liquid asset. However, a recent research paper from the European Central Bank raised concerns that a surge in gold demand could introduce financial instability, citing leverage and opacity within the commodity trading system as potential vulnerabilities, particularly during periods of crisis. Market analysts, however, argue the ECB's concerns may overlook the deeper structural tension at play. According to strategist Rafi Farber, the current financial architecture still operates with an unspoken dependency on gold, a legacy of the pre-1971 era when the metal directly backed currencies. In this sense, fiat currencies function as derivatives of gold, and the system itself inherently encourages gold shorting to maintain currency credibility. This dynamic has contributed to what appears as systemic suppression, more a feature of the monetary framework than a coordinated effort. As debt burdens grow and confidence in fiat stability wanes, any unwinding of this leverage could reassert gold's central role, not just as a commodity, but as a pillar of monetary trust. Now, we present the clips from Rafi's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
if it was just another commodity, I mean, they're not saying anything about oil. They're not saying anything about nickel, which was a problem in March 2022. They're not saying anything about any other commodity except gold. And now, but what importance does gold have to the ECB and its member banks? You know, if you're a Keynesian, then it's just what do they call it? They call it a barbarous relic. It has no connection to the monetary system anymore. Even people in the libertarian camp, they say, oh, we're no longer on the gold standard, so there's no connection, so it doesn't matter anymore. But then why would the ECB be so worried about gold specifically? This goes back to, it's ancient, I guess, ancient in the sense that libertarians have been arguing with ourselves about this, about is there systemic manipulation in the gold market or is there not? I'm on the not camp, not in the sense that I don't think there is any manipulation, but I don't think the manipulation is conscious. I just think it's a result of the system that we currently have. Now, the ECB looking at the leverage in the gold market, they're kind of stumped by it as well. They don't really understand why it's there, but it's a natural consequence of the propping up of the dollar and of all other currencies. I think I said this in a previous interview. I don't remember who it was with, but someone's asking me, like, who do I blame for the manipulation, the so-called manipulation in the gold and silver market? And I say, I blame myself. And I blame you too, because we all own dollars to some extent. And if we own dollars, therefore we are short gold and silver, because gold and silver are the derivative of those dollars. Now, the leverage in the system from the pressure, I guess the logical pressure of the regression principle, that the so-called fiat system had to start from issuing debt on top of a given gold reserve, those extra dollars filter back into the gold market through the futures and create what looks like manipulation. But it's just people following spreads and traders following where they can make a quick buck by bridging a spread and making a market, and happens to be in the gold market because that's where the dollar comes from. So rather than to say that it's a conscious manipulation by an elite group of people that are saying, oh, ho, ho, stroking their beards and saying, oh, we're going to manipulate the gold market and that's how we will keep the dollar alive and that's how we will enslave humanity by suppressing gold and silver prices, ho, ho, ho. It's not that. It's just a natural consequence of the system. And that's what the ECB is realizing without even like realizing what they're even saying so much. They're as confused as every other bank. They don't get why it's such a dangerous position for the bank system to be in. They're like, well, what does gold have to do with any of this? But they're looking at the positions. They have the inside scoop on it, right? They know which banks have what positions because they're in charge of all the banks, right? They're the central banks, and they're like, wow, well, if this blows up, then everyone's balance sheets are going to have holes in them because everyone's so short gold. Why is that? Why are they doing that? That's just how the system forces them to. It's what the system forces them to do because the dollar is a gold derivative. That's how it naturally winds up or unwinds. Yes, that is the idea. And that's what's so hard for many people to accept, because not that they don't see it logically. They say, okay, fine, logically I get your point. But the reasoning it goes so far back and it's like, why does it have to be that way? And it's hard. It's just hard for people to look like, okay, so it's logical, but therefore, when they go to a store and they give $1 for groceries, they only see their own consciousness of it. They don't connect it to past decisions, and it's hard. It's very hard to. You can't do it because we don't live past lives, right? Maybe somebody could have deja vu of a previous incarnation that they had in the 19th century when they were using gold coins and they called it $1. But most of us don't have that. So it's very difficult for people to accept it. And it's also difficult for central banks to accept it. Still, the fact is we are on a pyramid of economic decisions that this pyramid began either in 1873 with the end of the bimetallic standard, or in 1933 with the end of the gold standard, or in 1971 with the severing of the gold window. Really, those are just different stages in the same process. So it doesn't really matter where you count it from. It's all the same process over and over again. But this is where we are, and this is why when it all falls down, we're going to have to go all the way back in time, right? Because when this chain breaks, there's no other alternative than to go back in time to when you can last grab onto the chain, take hold of it, and keep going. And that's a very disruptive process, and a lot of people can't get through it. But it's another way to picture what the stacker's responsibility is. It's to take the gold from this generation, connect it to the chain back to when it was money directly, and then rebuild the economic chain. They are held down, but by inertia. See, there's a double-edged sword here. When somebody says in our community, the gold and silver prices are suppressed, if they weren't suppressed, we'd have a lot more purchasing power and everything would be better. I know I'm simplifying. I'm oversimplifying what they're saying, but like basically that's what they're saying. Why don't this manipulation end? And when it ends, we'll be back on sound money. Everything will be better. That's true if you take it in broad strokes. I'm not arguing that, but it's a double-edged sword, because if the manipulation ends, what they call the manipulation, what I'll agree is manipulation in a broad sense. Like, okay, so I'm not entirely disagreeing. When that ends, we're going to be at the end game. And then everything's going to collapse. So on the one hand, we're benefiting from the fact that gold and silver prices are being manipulated because it's enabling us to prepare. On the other hand, we want it to happen already. The minute this manipulation ends, the dollar will die. However you define the manipulation, whether you think it's an active group of people that are trying to do this, or whether you think it's part of the system like I do, even if you think it's an active group of people that are nefarious, what I don't agree with, what I think is wrong, is to say that if it is an active group of people, they can continue doing this forever. They can't. That's impossible. That's what the sort of the black-pilled stackers, or the black-pilled people, the ones that can't take a victory, or they see everything as doomed, and the people in power they can do anything they want, and we're just a bunch of serfs. I don't take that view. That I will fight that view. Like, I disagree with that 100%. Even if you think that they're in charge and they're nefarious, they're going to fail. Whether we think it's active or passive isn't really going to change what's going to happen. So I suggest that whatever camp you're in, we want the same things. However we see it happening, it's happening. And let's prepare for the end of it, because that's coming.
Recent movements in the gold and silver markets have revealed a notable resilience despite a brief sell-off, highlighting the metal's ongoing appeal as safe haven assets. This activity has sparked renewed debate within the precious metals community about the impact of Basel III regulations on gold pricing. While opinions diverge, some anticipating a positive influence and others expecting a negative effect, the prevailing view, supported by strategist Rafi Farber, is that Basel III is unlikely to dictate price direction, but will instead amplify market volatility. By tightening capital requirements for bullion banks, which traditionally facilitate liquidity by buying gold in London and selling it in New York, Basel III has constrained their market-making capacity. This reduction in liquidity has led to wider daily price swings and less stable trading conditions. Rafi Farber emphasizes that since the rollout of Basel III, the gold futures market has experienced diminished open interest movement, accompanied by more pronounced intraday price fluctuations, which sometimes reach $100 or more in either direction. This reflects a market with lower liquidity and heightened volatility, making sharp price changes the new normal. Farber points out that this increased turbulence does not necessarily signal fundamental price shifts, but rather a structural change in how the market functions under the Basel III framework. Investors must, therefore, adjust their expectations, recognizing that the current environment favors more erratic price behavior as the market navigates this transitional phase.
So this reminds me of another argument that has been raging in the stackers community. What's the effect of Basel III? And some people have thought that it would be positive for gold prices. Some people have thought that it would be negative for gold prices. But where I fall out is that it won't be positive or negative. It'll just make everything more volatile. I don't want to get into the technicals of it now or why that is, but basically if Basel III should make it more difficult for market-making bullion banks to buy gold sellers and sell gold to buyers, which is what they do. They buy gold from sellers in London and they sell gold to buyers in New York. And that's why they have perpetual short positions in New York and perpetual long positions in London. And they make the market. And by making the market, you make it more liquid. And that by making it more liquid, you dampen the price changes. You add liquidity, you make up days less up and down days less down. Right? That's the point of it. So what we've been seeing since Basel III has been implemented is less movement in the open interest in New York. Right? You see these huge moves in gold, $100 up, $100 down, $150 up, $150 down. And a $70, $80 move, I don't know if what your experience has been, but I'm looking at my screen, I'm like, oh, another one of those, whatever, it'll be up tomorrow, or it'll reverse itself in a day or two or a week or whatever it's going to be. It's not like I remember in 2013 when suddenly in April 2013 gold was down like $100 and the stomach like dropped. You're saying like you feel kind of nauseous like this. I'm like, well, whatever, it's $70-$80. Well, who cares? It seems like the futures market is a lot less liquid. Open interest is not going up or down that much. So it seems like whoever was saying, and I think Keith Weiner was leading the charge on this, that Basel III would do nothing positive or negative for gold. It would just increase volatility in the daily price swings. I think that's what's playing out now. I mean, we'll see if it continues, but we're getting habituated to it. So one day gold's going to be up like $500, and we're going to be like, oh, whatever, and then it's going to be up $1,000. And then we're gonna be up whatever, and that's gonna be down 800. And this is gonna be it's gonna get crazier and crazier as we head to the end game. And then one day it's just gonna stop trading, and then it'll be done.
Gold itself is not the problem. Rather, it serves as a stark reflection of the vulnerabilities embedded within the global financial system. The European Central Bank's recent warnings highlight not the intrinsic value of gold, but the fragility of an economic framework that is increasingly reliant on debt and complex financial instruments. As Rafi Farber points out, this system depends heavily on promises, on IOUs, rather than tangible assets, making it vulnerable to shocks and loss of confidence. In turbulent times, paper gold, which represents claims on the metal rather than the metal itself, may become illiquid or even vanish, leaving investors exposed. However, physical gold retains its reliability and enduring worth, standing as a tangible safeguard amid growing uncertainty. The key question for investors is not whether to own gold, but whether they possess it in a way that ensures true security and stability when the financial system faces stress. That's it for today. Share your thoughts on Rafi's analysis of gold as a safe haven in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching,